Imagine you're handling payroll for an Agniveer, or you're sitting down to file their returns under the brand new Income Tax Act 2025. How exactly do you treat those contributions in the final withdrawal? Well, a major structural shift is happening in Indian taxation, and if you are a chartered accountant, a tax practitioner, or a business owner managing payroll, this is one specific transition you cannot afford to get wrong. Today, we're going to completely demystify the new statutory mechanics so you are fully prepared.
Welcome to this explainer. I am so glad you're here. We are going to focus our lens squarely on Section 125 of the newly enacted Income Tax Act 2025. We'll explore exactly how it replaces the old framework, what it means for your tax computations, and the crucial compliance updates you need to make to your payroll systems immediately. Here is our quick roadmap for today. We'll start with the core legal provision, then walk step by step through a practical numerical example, and finally, we'll cover the specific compliance mandates and the common pitfalls you'll want to avoid. Let's dive right in. So, let's set the stage by looking at the transition itself. As you know, the Income Tax Act 1961 stands repealed effective April 1st, 2026. What's really fascinating is how cleanly the old, somewhat fragmented rules have been rehoused. Think back to the old framework. You used to claim deductions under Section 80 CCH, right? And the exemptions sat over in Section 1012C. Well, under the new 2025 Act, the deduction is entirely governed by Section 125, and that tax-free withdrawal, it's now parked neatly in Schedule V. Getting your head around this mapping is the absolute first step to a seamless transition. All right, let's break down the actual legal mechanics of Section 125. The objective here is twofold: to provide structured, clear tax relief for individuals enrolled in the scheme, and to standardize the tax treatment of the matching contributions made by the central government. Subsection 3 of Section 125 gives us our statutory definitions. It defines the Agnipath Scheme strictly as the Armed Forces Enrollment Scheme introduced by the Ministry of Defense back in December 2022. But more importantly for us, it defines the Agniveer Corpus Fund. This fund holds the consolidated contributions of the Agniveer, the matching contributions of the government, and the interest accrued on both. This exact definition is critical because the tax benefits we're about to discuss are tied exclusively to this specific corpus fund. Now, here is where we get into the really interesting part: the dual deduction mechanism. Section 125 handles both sides of the contribution equation beautifully. It's essentially a mirrored benefit. Section 125(1) states that the individual Agniveer's own contribution to the corpus fund is 100% deductible from their total income. Then you flip to Section 125(2), which states that the matching contribution made by the central government is also 100% deductible. And this applies to amounts paid or deposited on or after the 1st of November 2022. This mechanism ensures that the entire corpus growth is sheltered from income tax during the active contribution phase. But what happens at the end of the service period? When the Agniveer exits the scheme and receives that big consolidated payout, how is it taxed? Well, under the new 2025 Act, you don't look at Section 125 for this. You look at Schedule V, specifically Table Serial Number 7. It clearly states that any payment from the Agniveer Corpus Fund to the enrolled person or their nominee is subject to nil tax. It is completely excluded from total income. So, from the very first deposited rupee to the final withdrawal, it enjoys a complete exempt style of protection. Let's translate this legislation into reality and look at a practical tax computation. Let's say an Agniveer has a base gross salary of 5 lakh rupees. Over the course of the year, the government makes a matching contribution of 1,50,000 rupees to the corpus fund. Now, pay attention here. As per Section 2L of the new Act, this government contribution must first be added to the gross salary. So your new gross is actually 6,50,000. Then the deductions kick in. You deduct the employee's own contribution of 1,50,000 under Section 125(1), and then you deduct the government's matching contribution of 1,50,000 under Section 125(2). Your net taxable income ultimately settles at 3,50,000 rupees. It's a very logical flow once you see it in action. Of course, as professionals, getting the math right is only half the job. The other half is compliance. Under the new Income Tax Rules 2026, the format for Form 16 and TDS returns has been updated, and you absolutely cannot just lump these deductions together anymore.
Employers and payroll managers must separately identify and report the gross and deductible amounts. You are going to see dedicated rows in the new forms, one specific line for the employee's contribution under Section 125.1 and a completely separate row for the government's contribution under Section 125.2. Updating your ERP and payroll software to capture these distinct fields starting April 1, 2026 is a non-negotiable step. Let's talk about the real world for a second. What are the common pitfalls you're going to see during this transition?
Old habits die hard, right? Here are the top mistakes you need to avoid. First, do not quote the old Section 80 CCH on investment declarations or TDS returns for the tax year 2026-27 onwards. The portal system will simply throw a validation error. You must use Section 125. Second is the calculation error we just went over, failing to add the government's contribution to the gross salary under Section 2L before claiming the 125.2 deduction. If you skip inflating the gross, your entire computation is wrong. And finally, don't confuse the two phases. Section 125 handles the yearly deposits, while Schedule V handles the final tax-free payout.
All right, let's wrap this all up with our key takeaways.
Let's lock this in. First, Section 125 is the new 80 CCH. Second, the law provides a dual 100% deduction, one for the employee's share under subsection 1 and one for the government's share under subsection 2. Third, when the service ends, that final withdrawal is fully tax-exempt under Schedule V. And finally, your Form 16 and payroll systems must accurately bifurcate these streams under the new 2026 rules. So, as we speed toward April 2026, I'll leave you with this thought. Are your payroll systems genuinely ready to handle these dual reporting demands? Or will you be caught fixing validation errors at the 11th hour?
Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.